Have you ever gotten yourself into a trade right at a support level and you're like, you know what? Oh, I need to get in this trade. It could bounce right now, even though there's two more levels underneath it and there's a really big level at the bottom. But you know what? I'm going to go in. And you have a strict stop loss. And guess what? Hits your stop loss. And you're like, really? Really? And then you get back in the next support and resistance. And then you get stopped out again. And you're like, oh my God. And it goes down to the very bottom. And at this point, you're a bit nervous. You're being reckless. And you're like, do you know what? I've had two losses. I'm going to sit this one out. Clearly, it's not my day. And guess what happens? Poop. Flies up, hits your TP. And you're like, really? And you might have even entered another one in between that and probably got stopped out. Probably went into a short thinking that, oh, it's definitely going to go down. But no, your original thesis was perfect. But you were using strict stop losses. And you ask yourself, there has to be a better way of managing risk than just using these damn strict stop losses. And there is. And if you would use, one of these methods that I'm going to show you right now, you might have been actually profitable in that trade. So, what are the different types? You can probably tell from the title anyway. You have strict stop losses, you have hedging, and you have adding to a losing trade. Adding to a losing trade. Are you serious? Yes, I'm serious. Everything has a purpose and a time. And as long as you manage your risk right and there's a purpose behind every single trade you take, then it is completely fine to add to a losing trade if your original thesis is still good and you're not over risking. Okay? So back off. It works if you do it right. And when it comes to hedging, disclaimer here, not all prop firms allow it. Not all brokers allow it. It's up to you to figure out if you're allowed to use it. And if you're really terrible at managing risk, you should not do hedging at all. I have another video that I just did that's the first in this playlist. It's called How to Manage Your Risk Before You Enter a Trade, how to calculate your lot sizes, all that sort of stuff. If you are going to be going down the route of hedging, you need to know how to manage your risk first. I'm going to give you all arbitrary numbers here, but you have to input whatever risk that you have for yourself. It all depends on your account size. If you're on a funded challenge, it depends on a funded challenge. And I've had a lot of people that have said to me things like, you can't hedge on funded challenges. You can. It just depends on which ones. Funded Trading Plus, who I'm with, they allow me to hedge. My scalping broker, which is TD365, they allow me to hedge. And any broker I've actually tried in the past, all of them have allowed me to hedge. Now, I know there's a lot that doesn't. Now, maybe it's just the ones I've always picked, but it's always been an option for me. So don't come back to me now saying I've got kicked out of my funded challenge or my broker has screamed at me because I hedged when I wasn't allowed. You need to figure that out, okay? So with that disclaimer out of the way, let's get into it. What are the three different types and when should you use them? So let's go through the different types, okay? We all know what a stop loss is. Super easy. You say to yourself, I want to, get in on a trade here. My stop loss is going to be underneath here, and I'm going to risk up here. I'm going to create a limit order, set my trade, boop, 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 walk away. The only time I really use trades like that, a strict profit, a strict loss, and I don't manage it outside of that, is if I'm on holidays or if I'm not going to be at the computer for the day. So if I get on before market opened or during the day or whatever, and I say to myself, right, okay, I'm not going to be here for the day, or maybe if I'm not even going to be there for a few days, I would literally do something like this. If I know I'm not going to be trading for like 2 or 3 days, I'll look at an overall chart, whatever the hell I want to, whatever setup I see. Let's say I see this and I'm like, oh my God, this looks like it could definitely go all the way up here. I would set this trade, I would set and forget, and if I get it, I get it. And that's when I really use stop losses, or if I can't look at actual trades. As of right now, I'm in a trade currently and I have a stop loss set. Normally I would have a hedging order, but the reason I don't have one now is simply because I'm not looking at the trade. I'm currently in a NAS trade right now, which is running fabulously in profit. I'm targeting a psychological number of, I'm pulling my stuff around, targeting psychological number of 550. But again, this is all part of the strategy I do anyway. But again, that's what a stop loss is. Secondly, what's adding to a losing trade? Very, very simple. Let's say, for instance, this is actually a perfect example here. Well, it's not perfect, but let's say, for instance, okay, you are in this trade right now. Okay, and let's go back in time a little bit just so we get this in the books. Let's say here, okay. Again, this is adding to a losing trade. Now, adding to a losing trade and hedging can be done in the same trade. You can do, to be honest, it's really down. A lot of it as well is down to your trader intuition, and this is only something that will happen time in the market. So, for instance, here, let's say you're saying to yourself, right, well, there's a big area here. We could stop. We know what's going to happen, but let's say, for instance, we say to ourselves, okay, cool, I'm going to put a stop loss, or sorry, I'm going to put a trade here, and I'm going to target the bottom. Now, when it comes to adding to a losing position, instead of using your full risk, you would only use, let's say, half your risk. So I would say to myself right now, okay, there's one position here. There possibly is a position here it could bounce, and there's possibly a position it could bounce here. Okay. So what I would do in this position, and this again, this isn't an absolute perfect scenario here, but what I would do is I would open up a short position, and because I want to risk the high, I want to risk the high up here, I would obviously need to risk a little bit more, let's say 1 to 1.5. Again, this is not a perfect scenario here. And instead of, okay, if I wanted to calculate my risk on this, and if let's say my maximum risk per trade or in the entire day is €300, all right, and I could do two things. I could say to myself, right, all right, I can do this, okay, I can add a stop loss here, all right. I could right click, create a custom order, put in my, I can't do that now because I'm not on this is in replay mode. But if I right click and click create order, I can put in the amount I want to risk if your broker's attached. Again, I have another video before this one that will explain it. Create a custom order, and then I can put in my risk of 100. But then, well, obviously we know what happens in this one. We get taken out. So, flies up and takes us out. Now, in the situation of adding to a losing trade, in this situation, I could say to myself, right, there is a probability and possibility could go up here. So I would do this. I would set my risk up here. I would take a bit of a, see, this is a 1 to 5 hour trade, which isn't bad. But again, this isn't the perfect scenario here. Normally, I would say maybe up here, and it would start up here. That's probably more of a more realistic scenario, but again, I just want to show you as an example. So now we right click, we create custom order, and we want to risk €100 on this trade. You can use your forex calculators, whatever you like, just risk €100 on this trade. And then what you do is, okay, because your risk is all the way up here, you have given yourself 3 opportunities to get it right. All right, so now we get, but the thing about adding to a losing trade is that you need to pick a point that if it goes above, everything is null and void and you have to exit the trade. Where hedging, you don't have to do that. So again, we'll place another order, which will be essentially at the next point we feel like it could reverse. All right, so that's here. And then if we place it exactly the same place, the risk, and the same risk to reward, or you could play around with this, is up to yourself. And then what do you do? This one is a 1 to 5 hour. This one has a 1 to 2.7 hour. Then you right click, you find out you create custom order, you put in you want to do €100, it will work out your lot size, and then you'll have a better risk to reward on this one. And now let's say it goes against your favor again. You have one more opportunity, which is up here. Again, your risk is here. All right, so let's say in this scenario, we bring it up to the very top. Again, not ideal scenario, it's just an example here. Okay, and then the last one is all the way down here. All right, and now you do the same thing. Right click, create custom order. Okay, and now you have a 1 to 5.7 hour trade here. So all of them together, I don't even know what it adds up to be, but it's a lot more than if you failed at this trade, failed at that trade, and then you went on to the next one with this, with the, let me line this up here, with the mindset that you have already stopped out in 3 trades, okay? But now you've split your risk between 3 trades, and if it goes up here and stops you out, who cares? It'll be the same thing anyway. But again, the point is that if you were right on this first trade, you get profit. If you were right in the second trade, you got profit. If you were right in this trade, you got mega profit. But if you're wrong in this trade, that's grand. You're wrong in this trade, it's grand. You're wrong in this trade. The whole point is that you're picking areas that it could reverse. It could have reversed at the first one, could have reversed at the second one. So if you always say to yourself, right, I'm going to always wait for the highest probability, which would be the top here, you could miss out on this move, you could miss out on this move. Again, that's the point. You might miss out on moves. Now, I think this one goes back up there, does it? Okay, perfect. It tags us in. I don't even know if this wins or not, if I'm going to be honest. This might just blow us out. Okay, it went down to the bottom. It tagged the bottom. So we could have taken our trades down here because we're in 3 trades. You know, if you want to be extra safe. Okay, it actually went to like this is current time right now. So funny enough, this could have been a trade that I could have been in right now. But you get what I'm talking about. If we break these lows right now, like look how close we are to taking profit. This would have been mega profit in this one. So if we right click and they said we were risking 100 this trade, so it tries to get as close as it can. So we get about 90 euro on this trade. We risk 100 euro on this one. We would end up getting 162, and then because we were tagged into this one as well, we would get 419. That's a lot of profit. It's a lot of profit for just adding to a losing trade. Or you could have lost this one, you could have lost this one, and yes, you could have taken this one up here with your max risk, and yes, but that is an ideal world. It might have reversed here, it might have stayed reversed here. Like this was a really ideal scenario. Again, the point of hedging is that you're trying to fix a trade that you've already gotten into. It's very easy for me to say, oh, but like if you just entered up here, you would have got like, you know, if you risked a maximum 300 up here, you got 1,000. Of course that would make sense. But when we're trading, that doesn't always happen, does it? Okay, you need to trade what you see. In this scenario, I saw that it could have reversed here and I could have brought it down. It didn't happen. I saw another area that could happen. It didn't happen. So again, you have to take it as it is, okay? So remember, the point of adding to a losing trade or hedging is that when you are in a losing trade, you are able to turn it into a winning trade, okay? Again, in an ideal scenario, you'd be like, oh, but why did you take that one? Why did you take this one? Why didn't you take the top one? That's not always the case, okay? It's if that was always the case, we'd always pick the perfect trades. You wouldn't be watching this video right now, would you? So again, the point of adding to a losing trade is that your original idea is still valid, okay? It is still going down, but if there is a point that it breaks past, your trade is completely null and void, okay? So hedging is another beast altogether. The point of hedging is that you're essentially trying to mitigate your risk until the next trading opportunity happens so that you can turn your original trade into a winning trade. Okay, even though you could be really, really massively into the minus. Okay, so I'm going to give you a little bit of an example up here, okay? So let's say we have a resistance zone up here. We have resistance zone here. We have another one, let's say down here. The market is currently uptrending. Okay, let's say whoops. Let's say the market is uptrending. We come up here. We bounce around for a while, we come up, we bounce around for a while, we come up, and what do? We get in on a trade here, okay? We say to ourselves, right, I'm getting in on a break. My risk is going to be down here, and my reward is going to be all the way up here, okay? A 1.5 risk to reward, okay? And I get into that trade. But you have to make sure your risk is managed before you get into a trade. As I said, I did a video before this explaining how to manage your risk before you get into a trade. So if you are initially going to be risking, let's say, 300 euro per trade, let's say that's 1% of your account. What you could do if you were normally trading, you would literally just come in here, create your limit order, put in your risk as 300, you would set the trade, and if the trade goes against you, you lose 300 euro. Okay, simple. You look for your next trade, you lose your next one, you know you've lost 600 euro. But what you do when you're hedging is you split your risk into halves or thirds. So instead of using 300, you would use 100. Okay, so let's say I create that order right now. Oh, I've created as a stop order. I create that order right now, okay? Now I've created that order, I'm tagged into the trade. If I go up here, I win. If I go down here, I lose. So now what I would do, I get rid of the stop order and I replace the stop order with a sell order of equal size of whatever my lot size is of this one. And how do you work out your lot size based off your risk? My previous video shows you how to do it. So again, I'm going to use arbitrary numbers here. Let's say I am risking, 100 euro on these trades. So I'm going to put in 100 euro. It's going to work out my risk. I deleted that even though I didn't need to. So my lot size should be 0.3 based off of this trade. So what do? I get rid of this stop loss and I replace the stop loss with a sell order. So now I have a buy order that's already in play and I have a sell order that's down here that's going to trigger instead of a stop loss. And you're probably saying, why would I do that? The point is that you're trying to, you might have got into the trade early, but remember your original thesis for the trade is still in the same place. Now, disclaimer here, you should have an overall risk that once you hit, you exit all the trades. So in this scenario, instead of using 300 risk and giving myself one opportunity to get this, I split it between 3 trades and I give myself 3 opportunities to make money. as opposed to banking it all on one. So this trade now is risking 100 euro. Now, let's say it tags us in. We come down, it tags us in, and it crashes all the way down to here. Okay? But it starts consolidating here now. It doesn't crash all the way through, it starts consolidating, and this could be another area where it could reverse. Remember, I'm cherry picking here now. So what you do is you basically wait for the next obvious trade to present itself. And then what you do is you try to write it back up. Remember, your original idea is that it's going up. If it starts tanking all the way down to the ground, okay, and like you cannot figure out a way of getting out of it, then just take your 100 euro loss. Remember, if this goes down, look, if I drag the stop loss down, I'll be negative 200 euro at this point. But this sell order that I've triggered is plus 100. So if you think about that, instead of, let me get out my little tool for, where is that tool? Oh, it's up here. What is it? The tool to, text tool. There it is. So remember my trade one now. Trade one is minus 200. But trade 2 is plus 100, so we're net negative 100. Okay, doesn't matter now. This. Oh no. Oh yeah, that's grand. No. Oh my god, I'm creating loads of things. So you have to remember now, okay, that it doesn't matter if this goes all the way down here. Let's say this goes all the way down here, and it finds new support down here. Okay, let's say we're minus 400. Well, remember, this sell order is minus 300. We're still net negative 100. Doesn't matter. We're still net negative 100. Remember, your broker has to support this, by the way. Mine does. Funded Trading Plus allows hedging. My scalping platform, TD365, allows scalping. You have to make sure that happens. You can't have a small account either. Again, remember, disclaimer. So again, I'm not going to use this scenario here. I'm going to use this scenario that more of the time happens to me. So this is an exact scenario that's happened for me multiple times before, okay? Again, my original idea, I didn't just place this trade up here going, oh, you know, I think we're going to reverse up here. I placed it because I thought it was going to go higher. Everything is indicating it's going to go higher. I still believe it's going to go higher, but I believe right now we're in a pullback stage. So we're in a pullback stage. What do I do? Okay, so now what I do is this trade right now, all right, this trade right now, this sell order, I flip it for a buy order. So I exit that order and I lock in 100 euro profit. And now I exit it, I enter a third trade that is going to be down here. So now this sell order is gone, but I'm plus 100, but I'm still negative 200. Remember, now what do? I open up an order down here, a buy position of the same size again. We have to keep it the same size, okay? So now that we have that opened, now this is what normally, okay, this is a best case scenario. We have a buy position and a buy position. Let's say now we start going up. If we hit the halfway point, we can exit everything at break even, and we have made 100 euro profit from that sell position going down. So now this original position is break even, but I've made money. Okay, so my overall trade, instead of losing 300, if I use the strict stop loss, I have now made 100 and turned this original losing trade. Let's say if this starts plummeting all the way back down, doesn't matter. I've got out of break even. So that's why when you get to this midpoint, if it gets to that midpoint, you have to watch it like a hawk, okay? And make sure that it doesn't reverse, because if it reverses down here and this one, remember this new buy order goes into 100 euro minus. Okay. Right there now. If this goes into 100 euro minus, which is all the way down here, that would mean we will hit our maximum. I can't even click this, which is really annoying. So we're down here, okay? So this is minus 100. This is minus 300. We're plus 100. We would have hit our max loss of 300. You exit all the trades. Okay? That's a bad scenario, okay? But you still only have lost 300 euro. You've gained, okay, well, you've lost 400 euro here, but you've gained 300 euro from that short. Remember, you exited this short because it was an area you thought it was going to bounce. So now, that is a scenario where you would just get out. You've lost your 400 euro from two of these trades, but you gain a net positive from the short down here of 100. So again, you still have only lost 300 euro. But because I gave myself a second opportunity, let's say it does go in our favor, okay? Let's say it does go in our favor. And this doesn't happen. Let's say we come all the way up, back up here. This one now is break even, okay? This one now is in a €200 profit. Let's say now we exit our trades, because now it's a next area where it could consolidate, where people could be taking profits. Again, you don't hedge in areas where you know they have to be obvious, you know, important areas. So let's say in this scenario, now the first trade is minus, it's 0. Our second trade that was down it's plus 100, and this third trade is plus 200. We've actually made 300. I exit this one now. I want to be out of all the positions. Let's say it starts going back down here again or starts consolidating, you can do that. But what I would do is when this one is in profit and this one is back to break even, this one right here, I would exit out. Okay, now I've made €300 profit. And now let's say, God forbid, it comes back down again and you're back into €100 negative on this one again. Well, guess what? You re-enter again on the same size. Remember, this one now is gone, and you keep playing it until you're fully out of the position. Now look, if this goes back down to minus 100, remember, I'm still net positive 300 from this trade and that short position. So if this goes down, I could exit that position. Now if you're an idiot and you leave it go all the way back down here, all the way until you're minus 300, well, now you've erased the fact that you made 100 here and 300 here. Like, that doesn't make sense. Okay, so what I would normally would say, I would use a fixed kind of sum. And if I hit that, I would hedge again until I get out of the trade with as much profit as I can. There's been times where I've been hedging for hours and I've lost, I've gained, I've lost, I've gained, but net positive come out hundreds because I've followed these rules. Okay, so again, so let's say, remember, we're out of this position right now. We're at break even with this one. We have two options. Okay, we have two options. We can either leave this one, go up into positive, and it could, our original plan that we did all the way back here could have worked out, which would be great. It went all the way up here, our original plan worked out. Or it starts collapsing back down, you go into minus 100, you hedge again, or you just exit your position and you're still net positive 100. 200, obviously, sorry. So that's the power of hedging. But remember, you have to know what your max risk is. And if, let's say, your max risk is 500, so instead of doing 500 here, okay, you could split your risk up into 5 trades, risking 100. So now you have the max, you have literally 5 tries to make your original one a success. I know this can be complicated to look at, but you just have to play between the ranges. And as I said, remember, if you're in this sell, or if you're in this buy position, okay, and it goes into 100 negative, you try and get out of this sell position that opens up, that replaces your stop position at the next obvious place of consolidation, because you want it to go back up. If it starts collapsing back down, you have to get into another hedge position again, remember. So, and once you hit your max loss, you exit. This can take practice. I would use a demo account, but I'll honestly know this, I would say 8 times out of 10 works out for me. The times it doesn't, I take my max loss anyway per trade. So it happens regardless. Just remember, the whole point of hedging is that your original idea, your original bias is still in play. It's just you bloody bought at the top, and right now it's in a pullback before it breaks the top again. How many times has that happened to you? How many times have you tried to guess? You tried to guess where it was and it keeps going down. You keep getting stopped out. Well, if you had just done this and played your cards right and took a chill pill and actually, you know, really thought about your next position, because remember, when you hedge, you lock in your loss. So now you can really think about, right, okay, where is it going to bounce next? Where can I add my next long position so that I can ride it back up and bring my original position back to break even, or even make it hit my original TP? Okay? You've probably been in so many positions where you got in on the top and you just suffered through a pullback, maybe not use a stop loss at all. Well, if you did this right now, you would have made money on it going back down. You would have made money on it going back up, and then your original position would have went into profit, or you could have just got out of break even, and with those short positions going down, you still would have made money. Okay? Again, it's a case-by-case basis. But the whole point of all of this is to make sure that your original trade either is a win or a break even, or if you hit your max loss, you get out and you lose anyway. Or you could just set a trade, set a stop loss, set a take profit, and make it easy for yourself. But with the method I just showed you, you give yourself 2, 3, 4 opportunities to get it right. Okay, you should never enter into position anyway with full size. That's why you should, scale in. When people say scale in, well, if you scale in through hedging, the opportunity for you to make profit is quite high. But remember, you have your max loss, and if you hit it, you are out. Okay, so I hope that makes sense. I know it's very complicated. I probably have to do more videos on this, but this takes practice. Okay, so open up a demo account, do it on a demo account, master it, and trust me, the amount of losing trades you have will go so far down. So thank you so much. Like, share, comment, subscribe if you haven't already. I'll be doing a lot more videos on this. My next ones are going to be on my trading strategies. So let me know what you think, guys. If you have any questions, which no doubt you will, drop them below, and I'll talk to you soon.